Welcome, everybody, to the Daily Fool, where Jason and Moser and myself are going to give our thoughts on what's going on with a couple of earnings reports, the market for the day. This is our plan. We're going to give you a little bit of a market update, and we got a lot to talk about with GM. We were talking a little bit before the show. I have some hot takes about what's going on at GM, and they may be a little different than the market thinks right now. But Jason, I wanted to start. I'll pull up some of the market data for today. We are trading a little bit higher, but anything that's on your mind as we look at the day and kind of, this is the start of earnings season. I think this is really, to me, the day that things pick up.
Yeah. Gone are the days where Alcoa kicked off earnings season for us. It's a new dawn, Travis. I think probably the big story, or one of the big stories out there this morning, we saw this last night, was just the White House basically proposing for health insurers, particularly the Medicare Advantage payment side, essentially just keeping those payments flat. It seems like they were proposing bumping those payments up. I think they said 0.9%, whereas Wall Street was expecting somewhere in the neighborhood of like 4 to 5%.
United Health down 20%.
Yeah,
I saw that it was down this morning, but 20. I did not see 20.
Yeah, I mean, I would call that a bit of an overreaction. It's you got United Healthcare, you've got Humana, you've got CVS, Elevance. I mean, a lot of big health insurers out there feeling the pain this morning because this is a decision that impacts all of their business models. This is one of those things where, yes, it means something. Is it 20%? Does it mean 20%? I don't know. I think that's probably a little bit of a knee-jerk reaction, particularly when you consider, the durability and the resilience of healthcare in general. These are insurers that will continue to play a major role in that space. And you remember, it wasn't too long ago, we saw Berkshire Hathaway take a nice sizey position in United Healthcare. I think that was around like $245 per share, something like that. So they saw a deep value there with a company that really, I don't want to say too big to fail, Travis, but I do feel like a lot of these insurers kind of fall in that category of like United Healthcare can't just go away, right? I mean, it really matters. It and a lot of these other insurers. So I don't know. I mean, I think the 20% is probably a little bit of a knee-jerk reaction, but
and last time this happened, it was a great buying opportunity. I don't understand this space enough, and actually what I'm looking at in the healthcare space is more the disruption side.
Yeah.
So because there's just, especially in the US, things are so structurally messed up that they just can't keep going the way that they're going, and the incentives are all misaligned and all of that kind of stuff. So I'm looking at who are the companies that are creating what I think could be the future of healthcare. We'll probably talk about that in the next couple of weeks, but I think there's a lot of opportunity there. But this is like an immovable object too. In a lot of ways.
And I'll admit, like when United Healthcare was getting shellacked several months ago, I went ahead and added a few shares of that to my dividend my retirement portfolio solely for the dividend. I felt like, at that price, the valuation made enough sense, and it's one where I want to hang on to it because of the dividend. You said it, movable object. I mean, it doesn't mean those businesses, they can be altered, right? They can adjust. But you also see that they are also very dependent on which way the political winds are blowing too.
Yeah. Well, let's move to General Motors. And
they
reported earnings this morning. Stock was up a few percentage points. But I want to take a bit of a step back. We're not going to cover all the detailed numbers, but I want to talk a little bit about this strategically. I think about, all of my investments from a strategic perspective. Where are these companies going in 5-10 years? Look at the 5-year chart, and I pulled 3 companies here. This is General Motors is in purple. General Motors is the top performing out of GM, Tesla, and Rivian. I think if you add Ford in here, they would be beating them pretty well too. But they're beating Tesla, even though Tesla's had a pretty good run here over the past 6 months to a year. Rivian, we could look at a different time frame, and the numbers maybe look a little bit different. Tesla's beating on 3 years, 1 year. GM is again the winner. What I think is interesting here is that the narrative a few years ago, not all that long ago, I'll pull in some of the numbers from Tesla and why investors thought this, but the narrative was that GM was in serious trouble, that these Detroit companies were going to die. They were going to go bankrupt. I remember plenty of YouTube videos talking about GM going bankrupt. I did not think that in part because, and this is where I think it's interesting to just think about your perspective as an investor. Morgan Housel has talked about this, like, right, like all of your experiences is like, one billionth of the experiences in the world. So like you're seeing a very small microcosm. I'm butchering his quote,
No, I know what you mean though.
but you're seeing a very small piece of the world. And so if you live, for example, in California, I'm gonna just close. This is from the Department of Energy. If you live in California, what you're seeing is a lot of electric vehicle sales. I think this actually goes off the charts here, and this is an exponential chart. The middle line is 200,000 units registered, sold in a given state, and then the top is a million. Okay, so this is not a linear chart.
Yeah.
But look at California, just going crazy. Texas, about 200,000 units. I live in Minnesota here. Okay, we're right here. We have a handful within a block of us here. They're around, but they're definitely not beating Chevy and Chevy trucks right now. And so the context with which you see the world is one thing, and then you have to back it up with the data. And one of the things that has always struck me with the EV growth is that it was very, very concentrated in certain parts of the country, in particular California, and then I think some of the more dense populations on the East Coast as well.
Yeah.
I'm in the middle of the country, and we just don't see that kind of revolution happening. There's a number of different reasons for that, but I see a ton of Chevys. We're a Chevy area, Chevy GM area. You go to a different, I think we were driving through Nebraska. That's much more Ford, but those old American brands, that's where the money is being made, and that's being backed up by the fundamentals recently. This is a look at the revenue at Tesla and General Motors since the end of 2023. Okay. GM has grown a compound annual growth rate of 4%. It's not a huge growth rate. This is not going to be a huge growth company. Tesla's revenue is negative, and that's despite the fact they have all kinds of things like the energy business. This is going to even get worse for them over the next couple of years. So just big picture, I think it's important to keep in mind that the narrative of the market is not always correct, and you have to back up what you're looking at from an investment thesis with the fundamentals. And I just look at GM. Let me go over to Tesla here. So Tesla is trading for 15 times sales. I think GM is trading for about 0.3 times sales.
Wow.
So valuations at the end of the day will matter too. When are they going to matter for a company like Tesla? I have no idea.
Yeah.
But the opportunity, 2-3 years ago was really with GM.
Well, you know what they say, right? You don't sell the steak, you sell the sizzle. And that's what Elon Musk just does so well. Love it or not. I mean, that's what he does very well. And I mean, whether Optimus robots works out or not, I don't know. The power business seems to be doing okay, but I don't know how far that goes. But I remember vividly several years back. So I got to the Fool in 2010, and I think 2011 and 12, or 12 and 13, I was able to go out to the North American International Auto Show in Detroit and cover that for work. And that was like right at the time when, the Detroit Big Three were really, it was questionable as to whether they were going to be able to make it. There was obviously some government assistance there. Alan Mulally came into Ford. That made all the difference in the world. I actually got to interview Alan Mulally out there at the show. It was pretty cool.
He flew out there every single week. That just seemed crazy because he lived in in San Diego.
Well,
in La Jolla or something.
You meet people like David Gardner, for example, and you come away from meeting someone like David as this guy is just, you can't help but leave a room feeling better after speaking with him. Like, he's just an optimistic guy. He's got a great spin on things and a great take on the world. I would put Alan Mulally in that same category. The guy was he was inspirational. I don't know why. It was just sort of this intangible quality, but you could see even then, like, there was something on the floor buzzing with those Detroit Big Three that you just knew they were getting ready to get past this. They came up with some good ideas as far as, assembly line structure and minimizing costs and whatnot. So it was neat to see, but I could also tell, even going out there, like, and I think it's a great point you make, like, we look at things from our own perspective as to where we are. I'm in Northern Virginia, and yeah, I mean, we see a decent share of electric vehicles on the road here. But like my mom and dad, they live in Southwest Georgia. You go down there, and it's none to be seen, right? You go out to California, maybe that's big out there in San Francisco, but where you are, perhaps in the Midwest, maybe not so much. And so it is important to remember that like one location doesn't make the whole country, and that doesn't make the whole world. I lived in Cairo, Egypt for 3 years and in Astana, Kazakhstan for 2 years with my wife's work back in the early 2000s. And, one thing that became very clear out there was they're basically on like a 10-year lag. The tech that was rolling out here domestically, it's not that they weren't going to get it, but it was going to take a while to roll out to that side of the world. I'm sure that time frame has whittled down a little bit since then, but it's important to note nonetheless.
Yeah, let's dig into a couple of the financial metrics that I think investors are going to need to watch. This is whether you're looking at General Motors or Tesla or Rivian. Those are kind of the three companies that I think are really relevant here. One that just jumped out to me is they're quantifying what these regulatory benefits are. So there's some changes earlier in 2025 that the Trump administration put into effect. It wasn't just the $7,500 tax credit. It was actually the regulatory credits that I think California was the main state. They had basically allowed states to create these regulatory regimes where companies would have to buy these credits to if they were selling mostly ICE vehicles. That meant the EV companies were generating revenue off of that. And then I'll get to what the actual numbers for Tesla and Rivian are in a second. But for GM, the benefit of not having to buy those credits is going to be $500 to $750 million or thereabouts in 2026. So this is a pretty big number. That's one thing that jumped out to me. So let's put this into context of how much does this impact Tesla's bottom line. Over the in 2024, they generated $2.8 billion in regulatory credits.
Wow.
I will pull out and do. Let's see. I'll get the full trailing 12-month numbers here. So 2.1 billion over the past 12 months. But let's add in what's their net income. That's almost half of their net income over that period of time. If we do free cash flow instead of net income, that's a pretty significant. Free cash flow includes all kinds of things like inventory. But it's still a significant chunk because those regulatory credits are basically 100% margin.
Yeah.
For Rivian, it's even more important, and this is their investor letter. If I can find it here, I think it was $300 million in 2024. Oh, it's going to be this one over here. There we go. This is the Q4 2024 letter. The regulatory credits were $300 million for the quarter, $325 million. So they basically backloaded. One of the goofy things with Rivian is they said they were going to be gross margin positive in Q4 2024. This is the reason they were gross margin positive in 2024 is they took all of these credits in the fourth quarter and said, "Oh, look at us. Now we're gross margin positive." All this money no longer exists for them. Because they are 100% in the US. Tesla is probably going to have some credits left that are going to be coming from Europe. But the impact on these companies is pretty significant. This is Rivian. I got revenue in yellow and then operating profit. The operating profit is obviously going to include for the trailing 12 months and for 2024, that $300 million revenue number in the fourth quarter for regulatory credits. So this is a big deal. And this is one of the things that I think a lot of investors haven't realized how important that is to the financials of these companies. And even with those credits, Tesla's operating margins and gross margins are pretty much the same as what the traditional automakers are today. That means that in 2026, those margins are probably going to be worse than GM and Ford and Stellantis. I think GM is probably the best operator. But that's something that's not nothing for all of these companies, that those regulatory credits are going away. And that's going to be a tailwind for Detroit and a headwind for the EV companies.
Absolutely. Well, I mean, and the tax incentives, to boot. I mean, like for a long time, you had all the incentive in the world, right, to go out there and buy an EV because you at least were able to claim that tax credit. Those are now gone, and I think we've
Yep.
seen, we had the early adopters that have run through. I think as with any sort of new technology, there's a course that runs, and you have your early adopters that just jump in, head first and are just ready and optimistic, and that's great. And now the incentive is just not as great as it once was. And I don't know if that comes back. Maybe it will. I mean, again, we talk about sort of the directions that political winds are blowing. I mean, there could be, a new administration several years down the road that decides to go ahead and incorporate tax credits back into the mix there. We don't know. But I do think it's telling. I think it's interesting to see how we've seen that demand fall off, and it has at least partly coincided with the expiration of those credits.
Yeah, absolutely. And we will see where things go. I want to get to that disruption piece in just a second because I have some thoughts there as well. But the final thing from this earnings report that I thought was interesting is they started to give some timelines for their autonomous technology. So GM has what's called Super Cruise, going to be more or less similar to FSD when you're on the highway, and that's where most people are going to put most of their miles for FSD on the highway. But they have I think it's something like 350,000 miles that are mapped where you can operate Super Cruise. Not every vehicle has Super Cruise today, so this is something that's kind of rolling out on Escalades first, maybe isn't in the Chevy Trax. They are moving to now a hands-off, eyes-off. So hands-off is going to be the car will drive itself, but you have to be engaged. Your eyes have to be looking at the road.
Maybe like what, L3?
L2, that's L2. L3 is when you start to go eyes off. So the big difference there, and the reason that I've been critical of FSD and the narrative around that is the reason the difference between L2 and L3 is important is because the liability for any accidents then falls on the automaker.
Yeah.
So you go to L3, now they say, okay, you don't have to be paying attention, but if you smash into the car in front of you, we, GM, Tesla, whoever, is at fault. L2, they can just go fall back on, and Tesla has done this a million times. Sure, there was this accident, but you're supposed to be paying attention. And so the liability ultimately is on you. Actually, the only automaker that has a level 3 vehicle in the field today is, do you know this? Mercedes-Benz.
Mercedes-Benz.
Yeah, so very, very random. And I think it's a limited area. But they're rolling out some of these features, and they're not coming now. They're coming in the future, but this is going to be 2028. They're going to have LiDAR, radar, and cameras. So this is kind of become the standard technology for everyone except Tesla, is that you can have all of these redundancies. And a lot of this is going to be.
I was going to say, I'm glad you brought that up because that's one thing that kind of bugs me about this whole FSD thing. Number one, talking about fault. And I mean, I think listen, Tesla, I think, kind of dug their own grave with that one. Just labeling it FSD and marketing that way.
Yep.
I mean, that implies something. And that's just, you shouldn't have done that. But then also this battle between radar and LiDAR and cameras. And it does feel like you're going to have to utilize all of that technology in order to get that redundancy.
And why not? If you have it.
Yeah.
Yeah. If you have it if you have the capability to put a LiDAR, which can see through snow, can see through rain. It's a different failure mode than cameras are. Why wouldn't you use it? And the crazy thing to me is that the criticism of LiDAR 10 years ago was that it was too expensive. Yeah. Everything we know about technology, everything is that the costs come down. They don't come down in a linear fashion. They come down in an exponential fashion. So we knew even then, yes, a LiDAR is $10,000. But in 10 years, it was going to be $100. And guess what? Today, it's $100. And so it's just not that expensive to put LiDAR and these, advanced radars and just have those inputs in. If you can do it, why not do it?
I mean, as a consumer, what would you rather have? Right. I mean, hey, we're just telling you that radar's the best. And this is just, this is our deal, or camera's the best. And that's our deal. Or we're going to give you everything because we believe that total solution is the safest and most optimal for everyone. I think consumers even would start looking at that saying, well, that's a little bit of a difference there. I want the safest self-driving car I can possibly get. Right.
Right.
I mean, that's one of the biggest question marks with those right now is how safe, will they be? And that's kind of the nut they're still trying to crack.
Yeah, and to just kind of put how different companies are thinking about this, I follow Mobileye pretty closely, and what they have talked about is, so they're actually moving to what they call imaging radar. So not lidar, but their systems have lidar today, but I think the future vision is to have cameras and then imaging radar, which is the same. It's a different failure mode, so you can see through. Radar is actually better in a lot of instances for things like weather than lidar is. But then you get some of the same, imaging impact. So it's all kind of complicated, and the images look kind of weird.
Yeah.
But what they have talked about is they want to have two failure mode or two systems that have different failure modes. And so their goal is to then have 1,000 hours, not miles, hours between failures with each failure mode. And if they have different failure modes, then you basically multiply them together. You should have 1,000,000 hours between each critical failure.
Yeah.
1,000,000 hours is a lot of miles. What, 30 million miles? Let's say on average, if you're going 30 miles an hour, that is a long ways between failures. So that's their stated goal. And that's I think that's the way that you need to think about this is if you're looking at this kind of technology, what's the safety bar going to be and how are companies going to hit that? Because um, the more sensors you're able to put in here, the more compute you're able to put in your computer. But we know that all this stuff is getting better over time. But I think if you don't have those inputs, you're going to be behind the eight ball. But again, the fact that Tesla is the only one making the decision to go cameras only. Rivian came out with a very similar looking system a month or so ago. We knew that GM was going to be similar to this. It just seems like this is the way it's going. And the interesting thing for GM is by the end of the decade, you're going to be able to go out, buy a GM vehicle and just be able to let it drive itself. I
Yeah.
don't think people would have thought that 5 years ago.
Probably not. And it makes me think of uh, companies that are approaching their cloud strategy from that multi cloud strategy, right? I mean, you need that redundancy because if you are just reliant on one provider and that provider then fails, what's your
Yeah.
backup, right? So the multi cloud strategy, same thing. I think with the self driving cars, you really kind of need the multi detection strategy.
Yeah, absolutely. Final thing, two things that I want to kind of end on for people to think about. Um, I think we are at the point where we can say that Mary Barra is the best CEO in the auto business. And I think she's one of the best CEOs in corporate America today. If
Yeah.
you listen to their conference calls, it's just fact she has such control over what they're doing, how they're doing it, why they're doing it. I was listening to one, I think it was last year, and one of the other executives was talking, and he was just kind of fumbling a little bit with the question, and she just stepped in with just a crisp, clear answer, and it was just so apparent that she knew exactly what they were going to. You can go back to their conference calls 5 years ago, and their CFO too. I think it's Peter Jacobson, if I'm getting the name correct, but those two together have just said, this is what we're going to do. We're going to do it in a measured way. We're going to improve our vehicles. We're going to improve our costs. And just, they do it quarter after quarter after quarter after quarter.
Yep.
And it helps that they make, I think, a pretty compelling vehicle. It helps. Some of these things have been, policy decisions have been helps to them. Some of them have been headwinds, but they have navigated this industry, I think, better than anybody would have thought 5 or 6 years ago. People were saying that she was a terrible CEO. Now look at Tesla or look at GM stock. It is outperforming Tesla. They're outperforming Tesla from revenue growth. Their margins are phenomenal compared to every other company. I just think she's done a phenomenal job at GM.
Well, I mean, I think, you got to give them a little wiggle room to get started. But I kind of go back to when we talk about how we assess leadership, and that's a bit of a squishy topic. But
Yep.
one of the things I look for first is I'm just looking for leaders that just do what they say they're going to do. Right. And if they just continue to hit those targets and meet those milestones that they talk about, that they set, and they just continue to do that consistently, I mean, that tells me a lot right there. Or are they a leader that just kind of makes excuses, right? And Mary Barra has never been one that I've seen that makes excuses. Like if something
Yep.
goes wrong, she gets out in front of it and says, "Hey, listen, we take full responsibility. We're going to fix this, and this is what we're going to do." I think to your point, she just has a pretty good track record of doing what she said she's going to do.
Here's the financials in kind of this light blue color is free cash flow. So free cash flow, not operating cash flow, but free cash flow that they have to do whatever they want with. And what have they done? They have bought back a ton of stock. So when your shares are trading for 5 times earnings and you're buying back stock, that's a negative compound annual growth rate for the weighted shares outstanding of 12%. I think if you just go back to 2024 when they started doing some of their huge buybacks, it's even higher than that. They announced another $6 billion in buybacks today. Final thing that I wanted to get your thoughts on is I think one of the big takeaways of this dynamic with GM, with Tesla, with Rivian, what people thought was going to happen 3, 4, 5 years ago, and what is happening today is disruption and innovation. You have to think about the time frame. And the example that I always go back to, and I think it was actually Reid Hoffman that talked about this, was if you think about the disruption from the internet and media content. So you have words, you have sounds, and you have video. The words were extremely disruptive extremely quickly because it was really easy to publish a website, even going back to the late 90s.
Yeah.
Publish on a blog, and then it got easier and easier over time. But that's why newspapers, magazines just got absolutely obliterated by kind of the mid 2000s. By the late 2000s, it was kind of over. It was 10 years and it went from riding high, flying high to being out of business in a lot of cases.
Yep.
Music took a lot longer. I mean, Spotify really didn't start, gaining a ton of traction. If you look at their numbers back until the mid 2010s. Video is another thing. Yes, that came out in, what was it? Did they launch in 2009, 2008?
Yeah,
Netflix, but they didn't have they had tens of millions of subscribers, but it wasn't a billion people, even YouTube.
Right.
And then you go to the, so that took 15 years. So the duration of that disruption allows incumbents to react.
Yeah.
And the shorter the duration, the harder it is to react, because you have a business, you want to protect that business. Yes, you want to think about the future, but how are you going to build a business model that's built for the future? And you have this other company that's just focused on that future, and they're able to just simply crush you. When that time frame, Tesla's over 20 years old. When that time frame is counted in decades, now it's much, much easier for those incumbents to go, okay, yep, we need to build electric vehicles. Okay, we need to change our electric architecture. That's one of the things that a lot of these companies are working on now, so that we're a software-defined vehicle. We need to build this cloud infrastructure so that we can, talk to our vehicles all the time, collect data off them, upgrade services. We need to build a subscription business model. If all that stuff happened in 4 years, yes, GM, Ford, all those companies would be completely screwed. But it hasn't happened in 4 years. It's taken 15 years, and it's going to take another 5 to 10 years to really get to that point where all this stuff has to be out in the field, and they're just not as far behind as a lot of people thought they were going to be because of that long duration.
Yeah, I think that makes perfect sense. It's the nature of the disruption, and I think that the incumbents, as you say, your GMs and Fords of the world, have you could perhaps criticize them for being a little bit slow to respond in the beginning, but maybe they also knew that, hey, listen, we have a little bit more time than maybe a lot of people realize here to kind of react to what's going on in the market here. And it feels like they've really caught up very quickly.
Yeah. I mean, you could say a lot of the same things for, the energy disruption as well, right? I followed the solar industry for a long time.
Yeah.
That's gone through fits and starts. Yes, it's grown like crazy, but it has not destroyed the oil business or the natural gas business. Why don't we talk quick about UPS? What did you see from UPS today?
Yeah, I mean, a boring business probably for a lot. As a shareholder myself, I follow this company just because I'm interested in it, and it's one of those boring businesses that I feel like you could probably own for years to come, because it's hard to imagine UPS and the like not showing up at our doorstep on a daily or weekly basis. But it's a company that's been going through a bit of a challenging stretch here, and I'll get into that in a minute. But just in regard to the results, you talk about CEOs that just do what they say they're going to do, and I think Carol Tomé at UPS has really done that as well. The results were good. Revenue of $24.5 billion was above their guide of $24 billion. Consolidated operating margin of 11.8%. That was above their guidance. The domestic segment performed very well, $16.7 billion, better than their guidance. International, just over $5 billion, better than their guidance. I mentioned, I think it was yesterday when we were talking about this, the big question mark for UPS recently has been the dividend, because of these changes they've made to the business, right? In the big change is they're foregoing a lot of this Amazon volume, right? Before, Amazon was a huge customer of theirs. And just looking at it from the outside, you would think, oh, that's great, man. I mean, Amazon ships a lot of stuff. And that's true. But the problem, Travis, is that was really high volume for very, very low margin, right? It was helping their top line, but the margin on that shipment, on that volume, was very, very small. And so the company made this conscious decision about a year and a half ago that they wanted to wean themselves off of just taking in all of that Amazon volume. And there were some big question marks as to whether that was actually going to work. And ultimately, what it resulted in was dinging the financials. It juiced their payout ratio for that dividend up towards like 97 to 98%. And you start looking at it and thinking, oh man, okay, this is a 6.5% dividend yield. How long is that going to be sustainable? Are they going to cut the dividend? Now, I will say, a couple of quarters ago, and I've been paying attention to this, but I want to say Carol Tomei said in the call a couple of quarters ago, she said, as I wrap up, I want to touch on our financial position. UPS is rock solid strong, and so is our dividend. The UPS dividend is backed by solid free cash flow. That's correct. And a strong investment grade balance sheet. Also correct. We know how important the dividend is to our investors, and you have our commitment to a stable and growing dividend. Now, that was back when the market was really looking at this company glass half empty. But report today, they declared a quarterly dividend of $1.64. The board approved the dividend for the first quarter. And it really does seem like now they've made it past this transition on the Amazon volume, because the guidance they have coming up here for the full year of 2026 is encouraging. And then I just saw a headline pass here. They're cutting an additional 30,000 jobs that were related to that Amazon unwind. And so what we're going to see here, I think, over the course of 2026 is a much improved bottom line. And I suspect we'll see better days to come for UPS.
Do you think it's fair to say, just looking at the numbers, and the domestic is probably where we're going to see this Amazon impact the most?
Mostly, yeah.
So you have, and these read right to left. By the way, my hobby horse, we need to be consistent with this. Are we going right to left or left to right on financial results? But revenue did decline. So a year ago, $17.3 billion in revenue. In this most recent quarter, $16.8 billion in revenue. So that's the trade-off you're saying. Yes. We're giving up volume, we're giving up revenue, but the adjusted operating profit, and correct me if I'm wrong, but the reason that you would look at adjusted right now is some of those one-time costs related to the unwind are going to be in the GAAP numbers, and they're going to pull those out in the adjusted numbers. So the adjusted operating profit is down, but it's down just slightly, about $50 million to $1.706 billion. Is that the right way to sort of look at the numbers? Hey, yep, revenue is down, but margins are up. And so long term, this is not the huge problem that people maybe thought it would be.
I think that's exactly correct. And I think if you look even longer term, part of the strategy behind unwinding this Amazon business, it wasn't that they were just foregoing volume. What they're doing is they're focusing on more profitable volume. So they're looking more to the small and medium-sized businesses, and also, interestingly enough, the healthcare industry. And they made a couple of interesting acquisitions over the course of the last year to bring some of these care shipment companies into their fold. And you're talking about, when you think healthcare, I mean, obviously there's security involved, but it's got to be climate controlled. Like, a lot of times this requires refrigeration for long periods of time. And so they are
really in the logistics business.
Yeah, exactly. So, and they're leaning into the automation side of things, obviously, with these job cuts. And this strikes me as a business that could benefit from automation, right? I mean, this is a very automatable, if that's even a word, business. So I think between, cutting down on those excess costs, I mean, they're going to become leaner, and then focusing, I think, a little bit more on higher margin lines of business, including the small and medium-sized business, as well as healthcare. I think we'll see that top line start to reaccelerate here over the course of the next few years. And then the nice part is they're really going to be realizing a lot of bottom line benefit there. So it does, I'm not going to say they're fully out of the woods yet, because this is the type of company that would feel some pain if we enter into, or whenever we enter into, a recession. But it also seems like a business that is really, really important to our domestic economy, and clearly very important to the international economy. And I do appreciate that Carol Tomei, the CEO there, just continues to do what she says she's going to do. And I think the market is starting to believe her.
Do you think that a help for them is that it seems it seems like, and I don't have all the numbers in front of me, but it seems like Amazon eating all of commerce is kind of slowing. Like their retail sales growth in the US is not 30% anymore. It's, it's slower than you have. Yes, they're still taking market share, but the higher growth rate is going to be in those small businesses, the Shopify type
Shopify,
businesses.
exactly. That was the name I was
Yeah.
going to say.
Yeah,
Yep.
and so that's where if that is growing faster than Amazon, it's actually going to be better for them to ride that way, because now you're talking about millions of customers, not any individual customer that has power over you like Amazon. So that's a much better position to be as the shipper. Is that the right way to sort of frame what's going on right now?
I would think so. I mean, Amazon certainly is its own entity. I mean, clearly you've got fulfillment by Amazon that helps that cause as well. But to your point about Shopify, I mean, you're looking at millions and millions of customers there in that regard. And so there probably is a bit more diversification there. And we've already seen, I mean, Amazon is continuing to build out their logistics business, their fulfillment business. And so they're going to have
Yep.
to take on more of their own volume, because companies like FedEx and UPS are saying, look, we don't really feel like we're getting the benefit out of this relationship. So we're going to, kind of go our own way, and you guys enjoy what you're doing, but there are other ways we can butter our bread.
Yeah, it's so interesting, this dynamic, because they were always in sort of a strange position with Amazon, where
I
that
know.
was where the growth was, and you kind of had to, but you also knew at the same time they're holding that margin over you.
It's like a supplier
Let's
for Apple, right? Hey, that's
Oh
great.
my
You're a supplier
gosh.
for Apple, but oh my God. I mean, like that's the sword that cuts both ways, right? I mean, it's great. You're getting the volume, but that Apple commands that pricing relationship.
If there's a small company that gets a deal with Apple, this is just my unsolicited advice. Run for the hills. The second you get that pop in the stock. Uh, there was a company that made, I'm gonna blank on the name, but that made the silicon that went over the Apple Watch. They made a deal to make
Oh,
the glass. I don't remember if it was silicon or exactly what the material was, but the cover for the Apple Watch to sort of replace the glass is you have a a curved surface there. Is not the
yeah.
easiest thing to
It
make.
wasn't Corning, was no, that wasn't Corning.
No, it wasn't Corning.
Yeah.
I'll find it and maybe bring it up on tomorrow's show. But their stock popped. I think their CEO started selling stock like crazy, and within a couple of years, I think they were bankrupt,
Yeah.
because Apple made such big demands for, you have to build out this capacity and blah blah blah, and they couldn't do it effectively. It gets outside of their, going from a certain size business to a business that's 10 times that size is very, very, very difficult for a lot of
Very.
these companies, especially in manufacturing. That's why a company like Foxconn is so impressive. But there is a world littered with failed Apple suppliers, because they push those suppliers so hard, and the supplier goes, "Hey, this is if it's a 10x, 20x, or 0x, like I got to take the bet." So I don't envy that decision that they had to make, but it does often not worked out well.
That's correct.
All right, let's look at what we got coming up for the rest of the week. Tomorrow, I think the interesting one is going to be Starbucks.
Oh yeah. Yeah,
And
Starbucks in the
we'll
morning, and then afternoon, wow, Microsoft, Meta, Tesla, waste management,
Yeah.
another boring business I love. Trash is forever, Travis. Talk
Yes.
about your stable dividends. I hope that's a nice report, but yeah, it looks like we'll have a lot to talk about over the next few days.
Yes. So tomorrow morning we'll be back at 10 a.m. Eastern time. We'll definitely cover a few of those. ASML, I'm sure, will be on the docket as well. And then Thursday we will be here at 11. A lot to talk about on Thursday. So if you're looking for more from us, from Motley Fool Money, I'm going to be recording that tomorrow morning right after we record. So I'm on that show Wednesday and Friday. And then we've got some of the premium recs are coming out next week. So
No,
I'm sure you guys are wrapping those up.
sure thing.
All right. Thank you everybody for watching. Like I said, we will be back again with the Daily Fool tomorrow. For Jason Moser, I'm Travis Hoyam. Thanks, and Fool on.